How to prepare to buy a home with bad credit. This is probably the biggest reason why clients approach me. They're looking to purchase their first home. They're tired of paying extraordinary rent costs, and they're looking to buy a home, but they need help on their credit. In this episode, we're going to discuss how it's possible to make that purchase and improve your credit. In this episode, we're going to discuss what mortgage lenders are looking for to qualify a borrower. We'll take a look at different types of home loans and what the requirements look like for them. And then we'll look at things that you can do today to increase your credit score, more specifically, your mortgage credit score, to be more appealing for lenders. Okay, let's get to it. So believe it or not everybody who gets approved for a home mortgage has excellent credit, and sometimes they don't even really have that good a credit at all. The truth is that mortgage lenders have different requirements, and then there's different loan programs that have guideline requirements. In fact, I work with a lot of mortgage lenders that specialize in taking people from credit that's not qualifying and bringing them up to a place to where they can actually qualify and make a purchase. So let's first talk about what a mortgage score is, because this is going to be different than what any other score on the market is going to look like. First thing I want to tell you is that Credit Karma is not your mortgage score. Your mortgage score is actually going to be an industry-specific score, and it's a subset of FICO. It's actually your mortgage industry-specific score, and it's FICO 2, 4, and 5. The only way to actually get this score is to go directly through the lender to have them pull your credit, or to go directly through FICO to get those scores. So once you're able to view your actual mortgage score, what's considered a bad score or a not qualifying score? Well, there's a couple of different tiers. Really, anything under a 620 is in many cases going to lead to a situation where you're going to be denied. But truly, anything under a 580 is almost always going to lead to a situation where you're going to be denied. Now, there are exceptions. I've worked with lenders that before COVID had happened, they were able to do what's called a low score FHA, where even under a 580, they were still able to get certain borrowers qualified. Usually the requirements are that you have a high income, you have plenty of assets, so there has to be extenuating circumstances. And in many cases, those loans were actually really expensive, with rates being very high and also with your fees also being very high. So in order to get prepared for a mortgage, not only do you want to find your actual mortgage score, but you're going to want to pull your credit report. You're going to want to use some type of credit monitoring service that's going to give you all three of your credit bureaus side by side so that you can do an actual comparison. You're able to look at the account, you're able to see the account, when the account was open, when it was closed, how it's listed, the payment history, the balances. You're going to want to be able to see all that information across all three credit reports. It's been noted that 34% of borrowers are going to find errors on their credit report. That's an extraordinary high number of people. That's approximately 1/3 of people have errors that are on your credit reports, and I see this stuff all the time. I see discrepancies at a much higher rate than 1/3. In fact, just about everybody who comes my way, there's some kind of discrepancy or some kind of issue on their credit report as pertains to what an account really needs to look like to meet the legal requirements to maintain its status on a person's credit profile. So once you've subscribed to credit monitoring and you have all three of your credit reports that are listed side by side with all three of the different credit bureaus, you're going to want to take each account and you're going to want to make sure that everything on that account is recognizable to you. Where I see accounts where borrowers do not recognize the creditor is going to be on collections. And the reason is because usually this is a third-party collection agency trying to collect on a debt, and in almost all cases, borrowers don't recognize what that even is. Now, the Fair Credit Reporting Act says that if it's not 100% accurate, it's not verifiable, or it has errors, that it has to be either removed or corrected from your credit profile. So by the very nature that you don't recognize who this third party is, that is a good reason to dispute that account. If you're going to dispute collections, you need to go directly through the credit bureaus and dispute them with each one of the credit bureaus, Experian, TransUnion, and Equifax. You're also going to want to ask for verification of debt from the collection agency. And now when it comes to other accounts, maybe accounts that you're currently have in good standing, but you've had poor payment history, if you look over the last 24 months and you see discrepancies in when late pays may have happened, in other words, you may see that in 2021 in July, on one of the credit bureaus it shows you were late, on one of the credit bureaus it shows that you paid on time, and on another credit bureau 2 months before that it shows that you were late. All the information doesn't match up across all 3 bureaus. That's another really good reason to dispute that account. Now let's say that you've gone through your complete credit profile in the fashion that I just talked about. You're trying to clean it up. You're trying to get rid of the errors, the inaccuracies. You're trying to make sure that the third-party collections that are trying to collect on the debt indeed have the authority to collect on that debt. You've asked for verification from the collection agencies and everything's come back. Now, once you've gone through your credit profile and you pull your mortgage score again, if you're still not pulling qualifying scores, you might want to reach out to a professional company to get to the qualification area. It might be a situation to where you don't have enough credit and you're not pulling high enough scores because of that. It may be a situation that perhaps you may need to settle debt with a collection agency to grow your scores further. There could be a whole lot of different reasons as to why your credit scores are still underqualifying. The next thing that I would do is I'd have your financials ready to be looked over. If you have low scores and you have your financials intact, in many cases, the lender may be able to work with you. So you're going to want to have your W-2s, your taxes are going to need to be filed for the last couple of years. You're going to want to have bank statements available and ready to be shown to the lender. Okay, now let's take a look at the different loan programs that are available and the credit scores that are required in order to get into those specific loan programs. The first we're going to talk about is going to be conventional. In general, conventional loans are going to be the most popular loan program out there. But they're also, in most cases, the hardest loan program to attain. Most people that have credit challenges are going to find it very difficult to attain a conventional loan. What I like about conventional loans is that your limits as to what you can purchase are actually going to be higher than any other loan program minus your VA loans. But the scores that they're looking for are going to be 620 at minimum is what they're going to advertise. But the reality is that your mid-mortgage score is going to have to be a whole lot higher than that to get a qualification from automated underwriting in order for them to write out a pre-qualification for you. The next program that we're going to talk about is going to be FHA, and this is going to be a federally backed loan. FHA guidelines actually allow for you to have as low as a 500 score, but the general rule of thumb is that you need to be at least at a 620 mid-mortgage score to get qualified. In many cases, lenders can get it done if you're between a 580 and a 620, and this really is dependent upon kind of the climate of the real estate market and how loose or how tight lending is at the time. As I mentioned, pre-COVID, I know plenty of lenders that could get sub 580 scores done for an FHA product, meaning that you can have a 550 score, you can put down 10% on the mortgage, have a high income, pay a higher interest rate, pay much higher fees, and be able to get that loan done. The next program that we're going to talk about are going to be VA loans. In general, VA loans are also another really lenient loan program that allow for 0% down for our veterans. In general, they're going to want 580 and above in order to get qualified for that VA loan, but what I've noticed is that most lenders are really looking for a 620. Some can do a 600 just depending upon circumstances. The final loan program that we're going to talk about is USDA, and USDA is for your less populated areas, and you have to meet very specific requirements in order to kind of fit into that loan program, and usually USDA loans are looking for a 620 mortgage score at minimum in order to qualify for that program, which is also a 0% down program. Before I get into the last couple of points, please like my video and subscribe to my channel. I'll be working hard to bring you a video each weekday over credit, lending, real estate, and other relevant personal finance topics. All right, so we've talked about some things that you can do to prepare for a home loan, even if you have kind of lower scores. And you've probably realized by now that you don't need to have perfect credit in order to get a home loan. In fact, you can have fairly low scores and still get a home loan. My clients do it all the time. So you may be asking yourself, what can I do now to grow my scores? Well, we've already talked about the number one thing that you can do immediately is to get credit monitoring, look at all of your accounts, and try to pluck off any accounts that you don't believe are valid, that you don't recognize, that have any types of errors. And of course, along with that, your current creditors, if you have a singular late pay, let's say that happened 3 or 4 months ago, and you have perfect payment history, don't be scared to reach out to that creditor and ask them about that. Say, hey, is there something that we can do about that recent late pay? I've had perfect pay history with you since I've had this account. Is there anything that we can do about that late pay? Believe it or not, your creditors aren't big bullies like a lot of people think they are. A lot of them will actually work with you. Some creditors have a kind of one-time get-out-of-jail-free card. They'll give you the one. Some creditors will absolutely not give you the one, and there's other ways to go about dealing with those singular late pay type situations. In most companies, they're going to have a pathway to get those things righted. Even though you may call and talk to a customer service person and they may deny you, they probably have some kind of dispute resolution center that you could write a letter to and explain your situation, explain that you've only been late one time. There's somebody at that organization, in most cases, that will have the ability to correct that for you. Okay, the next best thing that you can do that can help your situation, and you're hearing me talk about this a lot, is you can get back on track and pay your bills on time starting today. If you've had situations in the past where you've been spotty on payment and you've had issues with keeping your credit card balances low, if you really want to get a mortgage, if you really want to get a home loan, then now is the time to start chiseling out paying your bills on time, paying down your credit cards, and doing the things that you probably know are going to help grow out your scores. One thing that I found that's helped me pay my bills on time is I have everything set up on auto pay. I have a separate account that's dedicated to just all of my bills. I have a budget. I have all those items that come out of my account. Everything's set to auto pay, so I never have to worry about a payment ever being made. I can't tell you how many times that I've seen clients that have really good incomes but are really, really busy, and they're consistently late on minimum payments for credit cards that have like a $25 or a $35 minimum payment. It's not because they can't afford it, it's just because they don't have it set up on auto pay, so they don't have to worry about it. Another thing that you can do that's gonna be beneficial is try not to close any accounts that you have out on your credit profile. That includes credit cards, and it also includes resisting the temptation to pay off installment loans early. If you pay off an auto loan, as an example, early, that is pre-term, there's a real good possibility that your credit scores are going to decrease. Anytime you pay off an installment loan before the term ends, you're going to see a decrease in scores. If you're in the home buying process or mode, that would not be the time to take on really big purchases. As an example, you don't want to buy a brand new vehicle or have a brand new car note when your primary goal is to buy a home. Odds are that vehicle is going to cause some problems when it comes to buying your home. The next thing you can do is save as much money as humanly possible. Try to put every dollar that you can save into a separate account and start saving for that home. And as I've mentioned in previous videos, oftentimes if you're a first-time home buyer, there's going to be plenty of options for 0% down. There's going to be plenty of options for other types of programs that can help you with closing costs, but you still need to show that you've saved money and you've been making that attempt. In other words, you can't have nothing in your bank account in your savings and expect a lender to take you seriously for buying a home. And finally, once you've taken all of these things into account and you've implemented all these things in order to prepare for that purchase of a home, make sure that you have the proper team surrounding you. That would be a credit consultant. It would be finding a lender that you can trust that works on problem credit. In other words, you're going to want to find a lender who is going to work with you as you're working on your credit. We work with hundreds of them, literally hundreds of them. Not all lenders are going to be willing to work with you if you have subprime credit or not qualifying scores. Make sure that you have a realtor in your life that understands that you're having issues right now, but you're working towards these goals. Again, not all realtors are going to want to deal with you if you don't have a pre-qualification in hand, but plenty will. plenty will. If they know that you've got a lender that you're dealing with that's going to work with you and you're working with a credit consultant, they'll certainly take time to help you better understand the real estate market in your local area.